Hi, everyone. Welcome. We'll get started in just a minute. If you could remember to mute yourself and have your videos off, just because we have a lot of participants joining us tonight. Thank you so much.
Social Security and Retirement Income Planning. Let's look at.
So welcome, everyone. Thanks for joining us tonight for Social Security and Retirement Income Planning. Our lovely presenter tonight is Michael Graff, and this workshop is sponsored by the Province Community Library, and it's offered through the Society for Financial Awareness, which is a nationwide 501 nonprofit public benefit corporation with a mission to provide financial education in local communities across America. And Michael Graff is a dear friend of mine. I've known him for a while now.
That's right.
He is a veteran of 35 years in the financial services industry and is an investment advisor representative, holding a series of 65 security license, which is a licensed life and health insurance agent, and is a chartered tax advisor. He represents SOFA, the Society for Financial Awareness in Massachusetts and Rhode Island. And he's been conducting financial education workshops for more than 5 years in libraries and other venues all over Massachusetts and here in Rhode Island, which is why I hooked him up with BCL. So thank you, Mike. Welcome. And we'll turn things over to you to get started.
All right, Amy, thank you very much. All right, welcome everybody to our presentation, Social Security and Retirement Income Planning. So we will get started. Let me see. Okay, very good. Well, I'm not going to bother with the introductory information on the screen here or discuss anything more about SOFA other than what Amy said, that we are a nonprofit organization. And again, we are, our mission is to bring financial education to adults all over the country. So certainly invite you to check out SOFA. I do have a book that I have written. It's available on Amazon. And the reason I mention it is because a lot of what we're going to be talking about this evening is in the book, obviously in much more detail. And I'm going to actually give everybody an opportunity to get a copy of the book later on in the presentation. So if you haven't already done this, you might want to get a pen and a piece of paper so that you can jot down questions, observations, and things that you want to bring up later on at the end of the presentation. So if you haven't done that, go ahead and grab a pen and paper. We are scheduled for 60 minutes this evening, so we're going to try to obviously stay right within that time frame. My goal this evening is to introduce this topic to you. By no means am I going to be able to completely educate you about Social Security and retirement income planning, but what I want to do is give you a solid foundation from which you can begin the process in an organized manner, so that as you proceed, you'll be able to do so more efficiently. Questions, please hold your questions until the end of the workshop. Again, jot them down. That way we can kind of move through the presentation and I won't get off the track because I won't be distracted at all. But we do want to address your questions as best we can. If for some reason we run out of time, I will be inviting you to reach out to me in another method or methods so that you can at least get the information that you're looking for. So this workshop is about helping you to understand Social Security and retirement income, which is really about maximizing what I guess we'll refer to as your retirement paycheck, utilizing all of the different resources that you'll have available to you and learning how to properly and efficiently leverage those resources into a retirement cash flow that will enable you to, well, live your desired lifestyle and maintain it throughout your retirement year. So that's really our objective this evening. What I want to do is I want to start with a real life example or a story of a couple that attended a Social Security workshop that I did back in 2017. Again, I can sort of lecture to you this evening, and I'm going to have to do a little bit of that and just give you basic information, but I want to relate it to an actual case so that that will help you to really learn not just the facts and figures, but also see how it's applied in an actual planning situation. So I've changed their names to protect the innocent, so to speak, and obviously I've hidden their images in this way. I'm going to call them Harry and Bess. And I want to start by giving you some background information, just so, again, you know a little bit more about who Harry and Bess are and how this relates to the planning that I did with them. First of all, Harry, he is 65 years old, born in 56. Bess is 62. When I first met with them, they talked about wanting to retire in 2020, something they actually both did. They're both in good health and have longevity in their families. This is an important part of retirement planning, looking at longevity, because frankly, our parents and grandparents, they expected to probably live, I don't know, 8, 12, maybe 15 years in retirement. But for us and in our situation, we're going to live much longer in retirement, probably double that. So it's very important to sort of think about longevity as you begin your retirement planning. Their pre-retirement living expenses, while they were still working, were about $5,000. We actually checked that. We have a way to calculate that and know it accurately. What they wanted to plan for post-retirement was about 80% of that number, or about $4,000 a month in expenses. At the point that they retire, they also want to budget for $7,500 annually to cover travel and discretionary expenses, what you might refer to as bucket list items, and they wanted to make sure they have that money available for at least 15 years into retirement. This would equate to a monthly expense amount of $4,625. And I want you to remember that number because it's going to come back a little bit later on, $4,625. Now, Harry's Social Security at the time we first met was projected to be at full retirement age, and we'll talk about what that term means. His full retirement age benefit would be $2,400 and change. Bess's would be just under $2,000. And at the time of our first meeting, they had in saved assets about $420,000 in tax-deferred retirement savings. They had about $140,000 in non-tax deferred savings and investments. They had no life insurance. They had no long-term care plan. They have a son who at the time and still is living independently. So that's important because in some cases, people do need to factor in kids, sometimes special needs children in their planning. In this case, that was not needed. No specified financial legacy objective. They plan to whatever money is left over when they're both gone. They do want that to go to their son, but they're not planning to leave him a specified amount of money. So legacy planning is also something that we discuss as part of the planning process. At the time that we first met, their primary concerns and goals were taxes. This is something that Harry was particularly concerned about. They were also concerned that they had not yet formulated a long-term care plan. They did not feel confident that they had saved enough money. And this is really the point of this kind of planning anyway, is that they felt like they had done a decent job saving, but they just weren't sure if it was enough. And they're planning to stay in their current home and do some traveling. Sometimes people plan to relocate or maybe buy a second home or something. In this particular case, they were planning to stay where they are and again do a little bit of traveling. So that's the background information on Harry and Bess. So the question then arises, what is the first thing that Harry and Bess have to do with regard to planning? Well, basically figure out when they can retire. Again, the timing of retirement is critical in the overall planning process and, for reasons that we'll be discussing. So when is that? Well, for a lot of people, they think about retiring based on an age, maybe 62, 65. In some cases, people say, I'm going to retire when I can start collecting my pension or Social Security. But actually, the answer to this question really is they can retire when they have enough passive income to cover their projected retirement expenses. Again, let me say it one more time. They can retire when they have enough passive income to cover their projected retirement expenses. Now, you remember that number that we worked on earlier, that 4625. This is the amount that they need in retirement to cover living and discretionary expenses. So, putting it another way, they can retire when they can transition from paying expenses from active income sources to paying expenses from passive income sources. So just to clarify that, active income is earned from the exchange of your time, labor, and expertise working for an employer. In other words, you go to work for an employer and you say, okay, here's my time, here's my labor, here's my expertise. They give you a paycheck in exchange for that. That's active income. Passive income is derived from sources that are independent of your work and generally received without your effort or your labor. So another way to put it is active income is you working for money. Passive income is money that's working for you. So here's some examples of passive income. So again, we've got distributions from different types of investments and savings accounts. You've got dividends, from stock holdings, bonds, bank interest accounts, annuities, even reverse mortgages, rental income. If you happen to have a pension, you happen to have cash value life insurance, these are all primary sources of passive income. And then there's the big one, which is Social Security. So, and obviously Social Security is the one that a lot of people think about, and so we'll obviously be talking a lot about that this evening. So when you do retirement income planning, we typically start with Social Security. The reason for that is because it's generally the foundational piece of retirement income. It's probably going to provide the most income, or at least a fairly significant share of retirement income. And again, sort of as that foundational piece. So I want to introduce a term now. It's called income replacement ratio. Now, you remember with Harry and Bess, they had talked about wanting to replace 80% of their income, their pre-retirement income, when they retire. For most retirees, they're going to need to figure out what that number is. It's typically between 60% and as much as 100%, in order for them to maintain or establish, their lifestyle that they want to live in retirement. So again, for everybody, that's going to be a different number, and part of the planning process is to discover what that number is. Social Security is typically going to provide about 20 to 40% of what that income replacement number ends up being. It's not going to replace, all of your pre-retirement income, but it's going to replace a percentage, and again, on average, about 20 to 40%. So that is going to create what I refer to as a Social Security retirement income gap. So the next question is, how do you bridge that gap? How do you cover that? Well, again, this is just a graphic which sort of shows, based on what your pre-retirement income is, your Social Security is going to replace a certain percentage of that, and then you've got to fill that gap. In this particular case, 80% is the number in this graphic. So, how do you fill that gap? We're going to be talking about that, obviously, as we go. Now, just a little background information on where most people get, or the average person gets their retirement income from. You'll see that about a third comes from Social Security. Pensions provide about 20%. Savings and investments, give or take, about 9%. A lot of people will work in retirement, part-time jobs, for example. That's going to provide about a third. And then, a little bit from other sources. And then as far as retirement expenses go, again, just to give you a little background information on this, about a third is going to go to housing, and then you've got transportation, obviously healthcare expenses, food, other items like that, about 10-11% from other, and then you've got some other things here, entertainment, apparel, cash contributions. Everybody's going to be a little bit different, but at least this gives you an idea of what the averages are. So as we kind of jump into the Social Security portion of this presentation, these are typical questions. I jotted these down because these are the questions that I typically get. And many of you probably have these same questions. For example, if you take your Social Security early, say before full retirement age, how much income will you lose? When and how much is your Social Security going to be taxed? Can you work and collect Social Security benefits? How can you benefit, for you married people, how can you benefit from a spouse's Social Security? Benefits for people that are divorced or if you've lost a spouse. And then really overall, how do you effectively use the Social Security within the context of an overall retirement income strategy? How do you do that? So Social Security, okay, so basically how much are we talking about here? Well, based on 2020 numbers, the average benefit was about $1,500, which over a 25-year period is going to equate to about $450,000. The maximum a person could receive is a little over $3,000 in 2020, and that would have equated to a little over $900,000 over a 25-year retirement horizon. If you're part of a married couple, again, as you can see, these numbers can end up being over $1 million over your lifetime. It's very important to obviously utilize the right strategy for Social Security. The wrong strategy could cost you tens of thousands. I've seen scenarios where it can actually cost more than $100,000. So again, that's why careful planning is obviously called for. Will Social Security be there? I get this question a lot, which is why I want to quickly address it. The trustees are saying that if nothing is done to fix Social Security in 2034, the system is going to go belly up, so to speak. Now, that doesn't mean that people would stop receiving Social Security checks. It simply means that the amount of money coming in will only cover about 79% of what's required, or basically your check you'd be receiving about 79 cents on the dollar. So again, what do you do here? Call your congressman, congresswoman, and say, do something about this. But it'll still be there. For my kids, I'm not so sure. For us, it'll be there in some form. All right, the three basic steps you need to cover in order to properly leverage your Social Security include reviewing your current Social Security benefits, understand the options that are available to you, and if you're married, to your spouse. And you want to develop a plan to properly leverage, optimize, maximize your lifetime benefits. So many of you have probably seen this particular document. It's your Social Security statement, and it's chock full of all kinds of information. It has your earnings records. Again, you can go back to when you got your first job, and it's going to tell you how much you earned in Social Security benefits right along. Then there is the amount that you have paid in, for example, what has been withheld from your paychecks. You can see what you've paid in total and what your employer has paid in, both for Social Security taxes and Medicare taxes. Good information, maybe not happy information, but it's there. And then it's also going to give you an idea of what you would receive at different ages. For example, if you claimed at 62, or if you claimed at full retirement age, or if you wait until age 70. There's also a term to be familiar with. It's called the primary insurance amount, which is essentially the amount that you're entitled to at full retirement age. This term is going to come up a couple of more times, so I wanted to introduce it to you. So one of the first things that you should do is set up your Social Security online access. So very quickly, you go to ssa.gov/my-account. It's going to give you the ability to manage your account. You can you can review your benefits, both Social Security and Medicare. You can update your address. Once you're getting your payments, you can update your direct deposit information if you need to. So if you want to create an account, you're just going to click this link right here. If you already have an account and you want to double check on things, which I do periodically, I click on the sign in and, password and all that, and you're in, and you can double check things. All right, another interesting question here is, how are Social Security benefits calculated? It's based on the top 35 years of your earnings, indexed to inflation. So, for example, if you have worked, say, over a 40-year period, then Social Security is going to take the best 35 years. They're going to throw out, the lowest 5 years. But let's say you've only worked for 30 years. Well, then what they're going to do is they're going to take those 30 years and then they're going to add in some zeros. Now, I'm not saying, that that's necessarily a bad thing, but it's just something to be aware of, that they're always going to take that 35-year period and use that to determine your primary insurance amount. Now, here's how the formula works. And again, we're just going to, do this quickly just so you're aware of it. And there's actually a form that you can download from ssa.gov in order to do this. For you, people that like to do math out there, you'll enjoy this. Here's what the form kind of looks like. And it's a 7-step process. And I'll just quickly tell you how it works. Here's step 1. What you do is you get your earnings record. And you're going to take the information in this column right here. And then what you're going to do is you're going to enter at step 1 into column B, and you're going to record it all the way for each year. And then what you're going to do, step 2, is you're going to raise it to today's dollars. In other words, you're going to index it to inflation. And so you're going to take this factor number right here, and you're going to then multiply it out, and you're going to include the information here. And I mentioned this right here just as a quick example. I got my very first job, when I was 16 years old, at a restaurant called Pewter Pot. And in 1976, I earned $430, most of which went into my 1968 Chevrolet Bel Air. But in any case, when I decide to claim my Social Security, they're going to take that $430, going to index it to inflation. So it's actually going to be counted as $2,300 and change. So again, just an example of how this works. So let's take a closer look at some other aspects of Social Security. We're going to talk about what it means to be eligible or entitled versus entitled, claiming ages, cost of living, what it means to work and also claim your benefits, taxation of benefits, spousal benefits, what WEP and GPO, what these acronyms stand for, and then some quickly on some common claiming strategies. So to qualify for Social Security benefits, you have to earn a credit or a quarter. The way this is done, and this is based on 2020, during each quarter, 3-month period, if you had covered wages, which is basically a job where you pay into Social Security, of at least $1,410, then you would earn a single credit, 1 credit. The most you can earn in a calendar year, or in a year, is 4 credits. So the way this really works out is that, well, you need 40 credits in order to be eligible for Social Security. So if you work effectively 10 years in a covered, in a job where you are paying into Social Security, then you will qualify when you're eligible or at the claiming ages for Social Security. And by the way, that doesn't have to be consecutive. It just has to be a total of 10 years, 40 quarters in order to be eligible for Social Security. So here's a little bit about claiming ages. The earliest you can claim is 62. Then there is the full retirement age. And this varies depending on your year of birth. So if you were born, for example, between 1943 and 1954, then your full retirement age benefit is 66 years old. You can wait, however, until as late as 70. You would never want to go after 70 because there's no benefit to that. But there is a benefit if you want to wait after your full retirement age benefit. But again, this to understand what your full retirement age benefit is and what your claiming age options are. So here are some of the pros and cons of the different claiming ages. For example, you claim at age 62, the benefit is that you're receiving your benefits right at age 62. So it's kind of like, money now is better than money later in a way. But the disadvantage is that you're going to get a smaller check. And I'll show you what that is in just a moment. There's also the possibility, if you claim before your full retirement age and you're also working, then you could have a reduction in your Social Security benefit. I'll explain that in a moment as well. If you wait until your full retirement age to claim, then you're going to get a higher check. And there's also either a lower or no penalty if you're employed. But, and I guess refer to this as a disadvantage, that you did not collect benefits from age 62 until whatever your full retirement age. So you didn't get that money. So count that as a disadvantage if you want. Then if you wait until age 70, you're going to get the highest possible check. There's no penalty if you're also working. But disadvantage, you didn't claim, you didn't get any money for, potentially for that 8-year period. So again, if that's a disadvantage, then we count it that way. But again, advantages and disadvantages to consider based on your claiming age. However, getting back to that comment I made earlier about maximizing or optimizing your Social Security, one of the things that we look at very carefully is, how does timing affect it? In many cases, it can actually be better for people to claim earlier, as early as 62. That may actually be the best option. So by no means should you just feel like, I should wait until age 70 because I'm going to maximize my paycheck. That may actually not be the best strategy. It's important to look at your situation and determine what's going to be optimal for you. So, but if you do claim early and your full retirement age benefit is 66, then you will lose 25% of your benefit. So if your primary insurance amount or full retirement age benefit is, say, $2,000, you collect early, it's going to be $1,500, and that's a permanent reduction. You can't ever get that back. If you wait until full retirement age, then you're going to get 100% or all of your primary insurance amount. And after your full retirement age, there's no penalty if you're working. If you wait until age 70, for every year you wait, you'll get an 8% bump in your pay. And again, if age 66 is your full retirement age benefit, then you'll get 32% more if you wait until age 70. Now, very quickly, when do you think most people claim their Social Security? The answer is, and this is according to Social Security, that 71% of people claim early. Now, we can speculate on why. Personally, I think it's because a lot of these people just haven't done planning. I think 71% is kind of a high number. Certainly, like I said, some people will benefit by claiming early, but I think with proper planning, some of those people might have opted to wait and may have ultimately done better with their Social Security had they done the right kind of planning. All right, cost of living. So what this does, this provides sort of inflation protection to help you maintain the purchasing power of your Social Security. And again, you can see from this grid right here, started in 1975, and there has been good years and bad years in terms of how Social Security has been increased to cover the cost of living. They use CPIE. I'm not going to get into a lot of explanation about that, but let's just look at it this way. Over the past 10 years, Social Security has averaged a 1.65% annual increase, which doesn't even cover regular inflation. So the point is that over time, your Social Security will lose some purchasing power, more than likely. And again, this is something to be aware of as you are doing your planning. How will working impact your Social Security benefits? All right, so there is this term called earnings test or earnings limit. So in 2020, if you claimed early before your full retirement age, say as early as 62, you could earn up to $18,240. For every $2 that you earn over that limit, you will lose, if you're collecting Social Security, you will lose $1. $1 will be withheld from your Social Security. In the year that you turn your full retirement age, you can earn more. You can earn up to $48,600. But for every $3 over that limit, you will have $1 withheld from your Social Security benefit. After your full retirement age, there is no limit to working. You can earn as much money as you want. There is no reduction in your Social Security. Now, I just want to make the point that this is only wages. anything that you might be getting from distributions from, say, an IRA or 401k or pension income, or withdrawals from certain types of investments, interest income, anything like that, annuities, none of that will impact this. It's only wages. So I just wanted to make that point. Also, this is a withholding. It's not an actual penalty. Believe it or not, the money actually comes back to you later. The money that Social Security might withhold does go back to you later. I'm not going to spend any time on it. There's a publication I'm listing down there if you want to look that up. But it does actually get back to you at a later time. Social Security taxation. There's something called provisional income. Now, provisional income is used by the Social Security Administration to, essentially calculate how you're going to be taxed. It is made up of 1/2 of whatever Social Security you're earning, wages if you're employed or self-employed. This includes distributions from things like IRAs and 401ks, interest from bonds, banks, and dividend income, capital gains. It also includes pension payments. And here's how it works. Here's how taxation works. If you're a person who is single, filing an individual return, if your provisional income is under $25,000, then none of your Social Security is taxed. If it's between $25,000 and $34,000, then 50% of your Social Security is subject to taxation. Over $34,000, then 85% of your Social Security ends up being subject to taxation. If you're married, filing jointly, the numbers here, the covered or the limits are a little bit higher. Essentially, 15% of your Social Security will never be taxed, but up to 85% of your Social Security is subject to income taxes. Now, there are strategies that can be utilized to reduce, or in some cases even eliminate, taxation of your Social Security. And again, I'm not going to go into that this evening, but there are strategies that we can certainly discuss. But it's important. I also want to point out, this is important, that there are certain types of income that do not impact, that are not counted as provisional income and won't impact taxation of your Social Security. They include Roth IRA distributions, distributions or withdrawals from cash value life insurance, also certain types of annuities. Some of the annuity payment would not be subject to this. So again, just to point that out as well, if you have those types of income, that can be helpful in terms of controlling the taxation of Social Security. Spousal benefits. Okay, so if you are, and I refer to the spouse as the lower of the wage earners, whether that's the man or the woman, but whoever is the lower wage earner, that person can either take their regular Social Security benefit, their own individual benefit, or if it's better, they can take the spousal benefit, which is 50% of the higher wage earner's benefit, okay? Or there's also the survivor benefit. And obviously this is, for people who have lost a spouse, they can collect up to 100% of the deceased spouse's benefit. So important aspects about Social Security spousal benefits include, again, you have to be at least 62. You have to have been married for at least 1 year. And also important to note that if you take the spousal benefit, just like the regular, a regular Social Security benefit, if you take it before your full retirement age, it's going to also be reduced. So I just wanted to make sure you're aware of that. In the event that a person is divorced, then it works this way. Again, you have to be 62. You have to have been married for at least 10 years. You have to have remained unmarried. Your ex-spouse has to be receiving their Social Security benefits, although there is a way to do that if they're not receiving their benefits. But again, if you are divorced, and again, I've had a lot of people come in and not realize that a lot of people think that, well, if I'm divorced, I'm not entitled to benefits from my ex, but that's not the case. In fact, if you meet certain criteria, such as I've indicated here, you can actually benefit from an ex-spouse's Social Security. By the way, without them necessarily knowing this, and I don't want to get into a discussion about this, but I've had some people that say, well, I don't want to have any communications with my ex You don't have to do that. If there's a divorce situation, again, offline, I'm happy to talk to you and give you more details on this. I've had a lot of people that have benefited from this, not realizing that it was an option. Survivor benefits. Again, well, actually, in this particular case, you can actually claim this as early as age 60. If you're disabled, actually as early as age 50. You must have been married for at least 9 months, or if you were divorced before your ex passed away, then it has to have been 10 years. You remain unmarried until after the age of 60. And again, this is a grid right here that shows how the benefits would be calculated for a survivor benefit. I'm not going to, sit on the screen here. If you want more information on this, I'm happy to take it offline with you. Okay, what do these acronyms stand for? Well, WEP stands for Windfall Elimination Provision, and GPO stands for the Government Pension Offset. So again, there's a lot of detail to this. I can't go into this evening. I just want to bring it up so you're aware of it. If you worked a job where you did not pay into Social Security, for example, if you worked for a municipality or the state and you were paying into the state or the municipal retirement plan and not paying into Social Security, but you also earned the 40 credits, so you're eligible for Social Security, then you may be subject to the WIP, the WEP or the GPO. So if that's the case, again, this is something you should definitely be aware of and you should look into, because it will or could impact your Social Security. Important note for couples: Social Security income will be reduced upon the death of the first spouse. The lower Social Security will be lost. So again, using the example of Harry and Bess Truman, okay, so let's say Harry is earning a Social Security income of $2,000 a month, and Bess is earning $1,500 a month, and one of them passes away. At that point, the $18,000 or the lower Social Security is going to be lost. That's an absolute. This means, in this particular example, the surviving spouse is going to lose 43% of their Social Security. Now, I make a point about this, and I actually emphasize the point for women because women live longer than men. So it's fairly likely, at least statistically, that it's the woman that's going to have to suffer the loss of the Social Security income, at the point where, in this particular case, the husband passes away. This is an important part of planning. I always bring this up to people that I talk to, and I always mention it because Social Security, again, for a couple, part of it's going to go when the first one is gone. Okay. There's also a law, which I can't spend a lot of time on right now, but I always mention it. So if you were born before January 2nd of 1954, you may be eligible for some benefits that people born after that date are not eligible for. So again, if you were born before January 2nd of 54, make a note on that. Let's talk about it. Common claiming strategies that may enhance your benefits. And again, I'm not going to spend a lot of time on this. The file and suspend strategy, that's for people that were born before that January 2nd, 54 figure. So keep that in mind. There's a do-over strategy. If for some reason you change your mind on your Social Security election and you do it within 1 year, then you have a do-over option. Happy to talk to you about that in more detail offline. There's also a start and then stop, and then you can restart your Social Security. In some cases, this is a strategy that I talk to people about. Again, I'm not going to go into the details now, but it's something that I keep in mind, and in some rare cases, it can be beneficial. There's also the backup savings strategy, which enables you to receive a lump sum after your full retirement age benefit if you have delayed taking your Social Security. Say your full retirement age is 66 and you waited till 68, and then all of a sudden you need a lump sum of cash. There's a way to get that with Social Security. I'll share the details with you offline. Okay. All right. So getting back to this screen right here, we remember the examples of passive income. A couple of things I want to just make mention of here. When you're doing your planning, you want to consider the guaranteed versus non-guaranteed aspects of what is comprising your retirement income. Guarantees are obviously great. Certain things are guaranteed. Certain other things are not necessarily guaranteed or not necessarily consistent. So keep this in mind when you are doing your planning relative to the different types of income that are available to you. Also, inflation. Using inflation, and again, the government tells us inflation is in the 2% range. Personally, I think it's higher. And actually, I know it's higher than that if you factor in things the government really doesn't mention to you. But if you use a 3% inflation rate, the purchasing power on your retirement income is going to diminish by 30% over 10 years, 90% over 30 years. So you want to make sure that your retirement income plan is going to help you to maintain your purchasing power over longer periods of time. Very important point relative to retirement planning. All right, so let's get back to Harry and Bess. So what are their planning options? And again, I can't get into a lot of detail with this. This is kind of a simplistic breakdown, but I think, it's an important point. I want to make the point. I'm going to show you three different things that we talked about. Can't obviously go into what we actually did, but there's pieces of all of these in what we ultimately have done for them in our monitoring. There's option A. Both take their Social Security in 2020 at the time of their retirement. So since this is before full retirement age for both of them, their Social Security is going to be reduced. Harry's is going to be reduced to 2,075. Bess's is going to be reduced to 1,500. So what this means is that they're going to have a Social Security income gap of about little over $1,000 a month, requiring annual distributions from their savings of about 12,000 and change. These distributions are projected to occur past age 70 and really through their life expectancies. These distributions are projected to be approximately $370,000. Option B, they decide to take their Social Security at full retirement age, but they're still going to retire in 2020. So what this means, all right, so Harry is going to receive, they're both going to receive their full retirement age benefit. The result is a Social Security income gap of only $187 per month, which is considered about break even. But because Harry is retiring 2 years before he takes a Social Security, and Bess is retiring 4 years before taking hers, they will be required to take distributions of about $160,000 from their Social Security before age 70, but should not need to take additional distributions after age 70, except for required distributions. Then there's option C. They both wait until age 70 to take their Social Security. Harry's will be increased because he got 8% per year for about a 4-year period. So his is going to be increased up to 3,200 and change. Beth is going to be increased to 2,600 and change. The result is an income gap. Again, remember, they're retiring in 2020, but they're waiting until age 70 to take their Social Security. So they're going to have to fill that gap, that $4,600 gap, and then once Harry turns 70, that gap will be reduced to 1,400. And then when Bess turns 70, and just to finish that thought, they will need to take $250,000 in distributions before age 70, before they both turn age 70. But after that, they're actually going to have a Social Security income surplus of about $1,200 a month. Over a 20-year period, this would add up to about $300,000. So, which option would you pick? The considerations on which option you would pick include For example, timing of when you want to retire, taxation of benefits, stock market risk, sequencing of withdrawals, and basically how you sequence the withdrawals and all the different retirement income resources that you have available to you, things like inflation, longevity, legacy considerations. All of these things factor into which option you take and how you structure your retirement strategy. Again, and there's planning decisions you make before age 70 and what you do after age 70 because of that Social Security cutoff number. So again, you know, it's a little complicated, but suffice it to say that this is why we start with Social Security. It's the foundational piece, and then we build on top of that. So what kind of retirement planning will you be doing? Okay, so are you going to be actually going forward and doing a carefully thought out type of plan, sitting down with an expert and you know, working out all the details? Or are you going to be the type of person that's just going to hope you scratch a ticket and win a lot of money? Now, I'm being a little facetious here, obviously, although I've actually heard that there are people that, and more people than probably we care to think are doing this, that actually are hoping to win the lottery in order to cover their retirement. Again, you know, just trying to bring a little levity to this, but the bottom line is that you should do careful planning and not hope for a scratch ticket. Okay, next steps. So the first thing that you should do is investigate your Social Security. Get a Social Security analysis, something I actually offer, and I'm going to be offering to everybody who's attending. What you do is, this is actually a form that I fill out, or I can send to you. You can fill out. So if you're interested in getting a complimentary Social Security analysis report, email me at sofawalpolema@gmail.com, and I'm happy to provide that information to you and follow up with a report. Now, here's what it looks like very briefly. It's a great report. It's got a lot of information. It allows you to compare different options so that you can see how things will look and project over time. So, you know, good report. I'm also going to offer people, again, because, I mean, I've gone through this information pretty quickly tonight, and I know that a lot of details, I could not, you know, cover a lot of details, but I have a more detailed publication, which I'm happy to provide you, which will, you know, give you some of the information in writing that you can refer back to. So if you'd like to receive that, again, email me, sofawalpolema@gmail. I'm also happy to provide you with, add you to my mailing list, my weekly email. It's the weekly economic update. It'll update you on current stock market and economic information. You know, just a good piece of information to have on a regular basis. So if you'd like to get that, email me as well. And if you'd like to get a complimentary copy of my book, just go to this website right here. It's 6stepsbook.com. Very simple. You know, fill in the information and I will mail you a copy. It's completely complimentary. And if you would like to speak with me further, go to this website right here, meetingmike.com. That'll bring you right to my calendar, and I'll be happy to, you know, if we're not able to address your questions this evening, or if you have other questions that come up later, I'm happy to speak with you one-on-one. And by the way, I do virtual meetings, you know, through Zoom or phone. I do have an office in Walpole, Massachusetts. It's right off the highway. If somebody wants to meet me in person, or I'm happy to actually, in some cases, you know, meet maybe at the libraries down there in Providence. So happy to do that as well. All right, so the keys to a financially secure retirement really include, just kind of wrap things up here, maximize your retirement assets and income sources, starting with Social Security. Properly review, understand, and determine the best and most efficient way to leverage your resources. Budget and spending efficiency. Obviously, you've got dollars flowing in, dollars flowing out. You know, how does that flow of dollars in and out, how does that impact, you know, your overall retirement strategy, your overall retirement assets? Make sure you're efficient there. Reduce taxes and fees. Protect against stock market losses and inflation. And there's strategies that will enable you to do that. Balance retirement assets with legacy objectives. Begin now. There's no wrong time to do this. I mean, except not doing it at all. Whether you're younger or you're older, if you haven't done a plan, let's get a plan done. With me or whoever. And it really starts with Social Security planning. That's really the place to start. Analyze your Social Security, establish that, and then build on top of it. That concludes the presentation. I want to thank everybody, and I'm happy to hang around. I'm going to stop the share here and turn it back over to Amy. All right. Amy, I think you might be muted.
Sorry.
Oh, okay, there you go. All right.
Thank you, everyone. Thank you for joining in for our presentation. I have not received any questions yet, so I don't know if anyone has any, but if you do, feel free to type it in the chat. If you have the little reaction feature, you could do like a raise your hand thing so I can see you, and then we can unmute you. And I put in the chat
Okay, yep.
Mike's email and the website for his book and his website, meetingmike.com. So if anyone wants to follow up with him, you are welcome.
I see a couple of there's some raised hands.
Oh, yes, okay. Yeah, so Mike, did you see anyone raise their hand first?
I see, yeah, okay, so let's see if I can. Okay, ask to unmute. Let's see, I see Adriana.
Okay. Yeah,
Yes. I wanted to let you know that the chat is disabled, so that's why people haven't been able to send a question.
Oh.
So you might need to.
Okay,
it says chat disabled, so there is no way we can send a question.
Oh, okay, all right.
Well, then we'll
okay.
answer
Amy, did you see that?
Yeah, I can't fix that from here. That was a setting that was set up when it was.
Well, if anybody has a question, I can. Adriana, do you have a verbal question?
Yeah, I'll ask. Personal.
Okay.
So you mentioned about collecting Social Security if you are divorced.
Yes.
But what about if your ex-husband is married? Do you still have access?
Yes, that does not play into it. If your ex-husband got remarried, that does not negatively impact your ability to collect off him. It's kind of a funny thing, but let's say he was married 10 times. As long as you were married to him for at least 10 years, then you have the option to collect off of his benefit if it's favorable for you. Some cases it's not favorable, but if it is, then it doesn't matter if he's remarried or not.
Oh, okay. I don't know. Does someone else has a question? Because I do have another question about reverse mortgage.
Okay, I can help you with reverse mortgage, but do me a favor, send me an email because I don't want to necessarily get into into that right now. Reverse mortgage is something that I'm very familiar with, but yeah, I can certainly address that offline with you.
So Mike, we have Heidi next, and then Kevin.
Yes.
So Heidi,
how would one pay into Social Security if you are self-employed? All right. Well, that's a function of how you file your tax return. And so if you're self-employed, let's say you're a sole proprietor, you're going to have a Schedule C attached to your 1040. And, however that 1040 comes down, whatever you end up you can either make estimated payments, which you may be doing, or at the end of the year, that should be reconciled by way of how you file your taxes. So that's actually a good question. If you are self-employed and you have a tax professional, that would be a question you want to pose to them. But bottom line is that, if you file your taxes correctly, some of that money is going to be going to Social Security. So you will be paying into the system.
Okay, Mike, now you have Kenneth has his hand raised.
Okay, let me.
Kenneth, I'm unmuting you.
Ken, are you there? I'm not sure. Yeah, I see Ken. I see your iPhone there, Ken. But
Okay.
let's see. Well, all right. So, well, while we're waiting for Ken, how about I see Annie's iPad.
I'll unmute Annie. Hi, Annie.
Hi, this is actually Mark, Annie's husband.
Oh, okay.
We're watching this together. My basic question is, if you do have a 401k
Yep.
that contributing to, now we also have personal IRAs. We have a Roth IRA and also a traditional. Would you recommend that would be best to maximize the Roth and the traditional, or should we focus on maximizing the 401k first, then contributing to the Roth and the traditional?
Okay, well, the 401k, what I tell people about a 401k is if you are getting a company match, then you definitely want to take advantage of the 401k at least up to the match. So for example, let's say the company is matching 3% of whatever you contribute, then you should put in at least the 3% because then you're basically getting a free bonus from your company because they're matching you 3%. So I would start there. Then with respect to the IRAs, I would probably, and again, I'd have to take a look at your situation in more detail. In some cases, a traditional IRA would be better, but sort of as a default right now, I do like the Roth IRAs because, you're going to be able to use that money later as a way to possibly better manage the taxation of your Social Security. So that's the first thing. The second thing is, tax rates are lower right now than they're likely to be in the future. So, so again, if you're going to be paying taxes, in some cases, that might be an argument for doing a traditional IRA. But in any case, a quick answer to your question: start with the 401k, and then we can take a closer look to see what makes more sense, the Roth or the traditional. And in some cases, one might be better than the other. It depends on your situation.
Okay. Thank you so much. That was really helpful.
Okay, good. All right.
Mike, so we'll take the last question. Kenneth just sent me through the chat, so I forwarded on to you.
Okay.
His question.
You mentioned some annuities are not taxed. Okay, so yeah, the way it works, this would be with a non-qualified annuity. And so when you take a distribution from a non-qualified annuity, some of that payment is considered return of premium. So that portion of your payment or what you're receiving on that annuity, the return of premium portion, is not counted towards provisional income. The other part of it would be. So if it's a non-tax qualified annuity, then the portion that's considered return of premium is not counted towards provisional income. If it's a qualified annuity, like an IRA type annuity, then all of the income would be counted as provisional income. Let's see. Single premium income annuities. Well, yeah, if you do a single premium income annuity and then later on you're taking a regular income, say annual or monthly, again, if it's a non-qualified annuity, then again, some of that is considered a return of premium and not provisional income. Okay, I see more information, on guaranteed and non-guaranteed passive income. Again, what I put up on the screen, some of that can be considered guaranteed. Some of it is not necessarily guaranteed.
Looks like we lost you for a second, Mike. All right, well, it is 7 o'clock, so I want to thank you all for attending. Let's see, so If you have any further questions, make sure you email Mike at sofawalpolema@gmail.com. And we will, yes, so Heidi just asked me if we will have the recording up. I was just going to mention that. We will have the recording up on the Providence Community Library YouTube channel if you would like to go over any of the slides to relook at the notes. So please feel free to do that. I'll probably have it up by the end of the week on our YouTube channel. So feel free to check it out this weekend. It should be up on there. Coming up next week, next Wednesday, same time, January 20th, 6 p.m., we have investment strategies during uncertain times. And the following week, Wednesday, January 27th, also at 6 p.m., we have tax smart retirement strategies. So I hope you guys can tune in for some more workshops with Mike. So we'll see you then. Thank you so much, everyone. Have a wonderful Wednesday night. Bye-bye.